Welcome back to the episode of my trading vlog, where most of the views come from returning subscribers. If that's you, I'd appreciate the thumbs up. If not, consider subscribing. You're going to want to. I'm going to show you fake chart patterns today. Yes, fake chart patterns. We're looking at Tesla on the hourly time frame, and I've been calling for a top here, and we've just been seeing the price push a little higher, a little higher, a little higher. I believe we are actually still topping, and this count that I've now completed still supports that. But we're talking about our fake chart patterns, and there's 3 of them right here. You're going to see a, quote, rising wedge, which actually led to a new high. We see a head and shoulder top, which actually led to a new high, and an ascending broadening wedge with a downward breakout, which actually led to a new high. How could these 3 different topping patterns all fail to be tops? Chart pattern analysis is supposed to work, right? And if you're a skeptic, you're like, ha, see, it doesn't work. But honestly, I think what this is a lack of discipline on the chart pattern analyst side. You've got to have the Elliott wave analysis to understand the patterns. The patterns are formed in specific ways, and there's rules for all of them. You may find a shape on a chart, but if wave count doesn't support the position, then it's what I'm calling a fake pattern. Thomas Bulkowski on the patternsite.com, he acknowledges this with busted chart pattern analysis. And so in a busted chart pattern, you get the breakout, but then guess what? It, quote, doesn't work out and price goes the other way. Now you can measure and still analyze the chart pattern as a busted chart pattern. And that's because what Bulkowski's busted chart pattern does is essentially correct the mistakes you made because you didn't know Elliott wave, which is incredible. I am going to put up a little blurb here that's going to show the Elliott wave degrees just to help you keep track, understand that waves build into degrees above them. Every motive wave has 5 waves, unless there are exceptions, and there's one right here. We'll get to that. Corrective waves have 3 waves. Motive waves are waves 1, 3, 5, A, and C. Corrective waves are 2, 4, and B. We'll get into all that later, or you can watch my other video. It's called Elliott Wave Explained. Maybe I'll put a little blurb and link there too. Let's start with a, quote, rising wedge through here. Why is this not a rising wedge? And why did it lead to a new high? Well, there's a few different kinds of triangles. I break them up into 3 categories. Your generic gold triangle, your leading diagonal triangle, okay? And your ending diagonal triangle. Whoa, yes. The rising wedge is an ending diagonal triangle. Now, the ending diagonal triangle only appears in specific waves. 5 and C, because we're signaling the end of a trend. Motive waves have 5 waves. That 5th wave is the end of the motive trend. And in the corrective trend, wave C is the last wave. So we can predict reversals based on those patterns appearing in those places. Otherwise, right, you get this, where you draw the pattern, you get the downward breakout, you're feeling really good, and then price pops higher. Here we have, in wave position A, quote, rising wedge. If you have a, quote, rising wedge in wave position A, don't think this bearish. It's not bearish, it's bullish. It's exactly the opposite of what you think. There is one characteristic here that we need to acknowledge. Well, there's 2, but the first is that we're going to be looking for an overlap between waves 1 and 4, which you don't actually see here unless you turn the candles on. Within the hourly time frame, we got that overlap. So I'm just zoomed out too far to see that. We have that, that's check. Now wave A is an impulse wave. So what we're looking for is alternating 5, 3, 5, 3, 5. 5 waves alternating between 5 and 3. As to say, a motive, corrective, motive, corrective, motive, corrective, where we break the motive rule in that wave 4 passes into wave 1. And when it's located in this way in wave A, it's leading, not ending. And here we go, big push higher. This takes us into why the head and shoulder top through here is also a fake chart pattern. In this book I read, everyone should read it, Elliott Wave Principle by Frost and Precher. They identify the head and shoulder top as the end of a motive trend, where the head is wave 5. If you're putting a head and shoulder down and you don't have a wave 5 at the top, no bueno. It's not going to work out, okay? Here you have wave B sending a new high, which happens in expanding corrective patterns, which are the most annoying chart patterns. There's different kinds of flats that can do that. Triangles can also do it. Oh, it's just the worst because you set new highs and new lows and it gets everyone going and thinking, hey, we're in a new trend, but you're really not. And if you're very tuned in to the count, you can actually spot these things going to happen. For instance, here's a motive wave A, impulse A, occurring in 3 waves. This tells us that the counter trend pressure down is rather weak, so the bias is bullish. Sure enough, the next wave is really bullish and actually sets a new high, but it doesn't do it in a motive trend. This is not a motive wave. If you analyze this as a motive wave, it doesn't make sense. And there's a few rules for that, and I won't go into that now. Go watch Elliott Wave Explained. Maybe I'll put a blurb up here too. What this is actually doing is creating a 3-wave form for wave B, not wave 5. And so this is actually a C wave through here in a measured move down, or a zigzag for wave C. And again, wave C is an impulse wave. If it occurs in 3 waves and not 5, then guess what? Bias is still bullish. Sure enough, price sets a new high. Pretty simple. Again, wave position. Rising wedges do not go in A or 1. Head and shoulders, they must have a head at wave 5. Now, the third fake chart pattern here is this ascending broadening wedge, which after a breakout should target the start of the pattern. Price didn't even start to get that low. It just turned around almost immediately and set a new high. And it's like, well, why is that? Because the ascending broadening wedge is a triangle, all right? Where do triangles occur? Most frequently, waves 4 and B. And here, we're neither in 4 or B. We're actually in a motive wave, wave 5. If you see a triangle in a motive position, you are looking for a leading or an ending diagonal triangle. This particular triangle does not have an overlap between its first and fourth waves, which disqualifies it as an ending or a leading diagonal triangle. And if it's not in wave B or 4, it's not really a triangle either. What this actually is more likely a channel with an overthrow. Let's just do that. Let's redraw as a channel. This is probably 1, 2, 3, 4, 5, A, B sets a new high, which is annoying, C, and then a 5th wave extension. 1, 2, 3. Breaks that channel. 4 finds support. 5 tops out there. We get our classic bearish divergence. This is a motive wave. So there are your fake chart patterns. Fake rising wedge, fake head and shoulder top, fake ascending broadening wedge. And of course, it's the Elliott wave principle that gives us the insight to identify those. I hope this was helpful. If it was, definitely hit like, subscribe, share, watch the other videos. That's all. Happy trading.